Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs. Welcome to another round of market updates. Today we cover the Twitter world, ECB, equity markets and FX. Fake Twitter reports by a potential hack attack into the Associated Press account sent the S&P 500 into a frenzy as the index plunged from 1580 to 1560 and back, all within 5 minutes. Reportedly, the move wiped out 136 billion from the index. The move came amidst positive momentum resulting from strong earnings reports from Netflix and Travelers Cos. The ECB, in a surprise move, is hosting its next meeting away from the bank's Frankfurt home. The bank is increasingly coming under pressure to cut interest rates. With inflation at the lower range of the band, there is scope for a 25 basis point cut. In relation to this, the ECB in the past has flooded the banks with 1 trillion euros in two long-term refinancing operations in late 2011 and early 2012. The banks have already paid back more than a quarter of the funds, which is a positive move, suggesting that they are ready to stand on their own feet again. However, repayment of these loans has driven down liquidity in the Eurozone, and in our Keynesian world, this is probably why the continent is still reeling. It needs more of the liquidity drug. Looking at earnings, out of approximately 200 company reports across all major exchanges, only 58% have beat earnings estimates, putting it in line with last quarter. But the market is still below the highs it hit during the current bull market. Furthermore, 44% of reports have beat revenue. If earnings seasons ended right now, this would be the worst reading since the financial crisis hit. In the S&P 500, 72% of the 102 companies in the index have reported results beating earnings estimates. Now that's slightly above the average beat rate of 70% over the last 4 quarters. However, only 45% beat revenue estimates, falling short of the average of 52% over the last 4 quarters. Now either way you look at it, earnings aren't exactly inspirational. On the Korean peninsula, the risk of miscalculations over the conflict is apparently increasing, according to officials. South Korean Defense Ministry spokesman Kim Min-seok said that the North is ready to conduct another nuclear test at any moment. Other officials have stated that diplomacy is the best route with North Korea. Fair to say, that ship set sail long ago. In FX markets, the dollar-yen has basically not gone anywhere in the last couple of trading sessions. It may as well not trade at all. All currency pairs denominated in yen have pretty much done the same thing, trading in a sideways fashion. Amidst the earnings and Twitter hype, the S&P 500 has been trading in a range-bound fashion, in between 1592 and 1540. The MACD divergence has gotten stronger, signaling a bearish trend to come. Looking at our favorite related markets, the Russell Small Cap Index has come closer to the moving average death cross, which is the MA20 going under the MA50. The index has recorded a double top at 954 and a lower high at 951, with lower lows at 909 and 888. The Nasdaq 100 index may be setting up a bull trap if the current level at 2825 is to be a lower high from 2863. That's all for this week's presentation. On behalf of Trading Pursuits, we'd like to wish you profitable trading.